Hi everyone, hope you're all doing well. Today I'm going to talk about the 4 stocks that I bought, not last week, the week before that. So I'm just going to update you guys so you guys know what I've been buying, what I've been selling, and keeps up that transparency. I want to make sure that you always are aware what stocks I've been buying, and I'm not going to sell any stocks secretly out of the background. So yeah, it just keeps up that transparency. And yeah, not sure if you saw the inflation data yesterday, sent the markets down massively, and that was, like I said on the video about a stock market recovery, not yesterday, the day before, is that that's probably going to be the key driver now. You know, we're at a tipping point, and that inflation data can really see us probably push higher for the next month, or probably push us a little bit lower, and it looks like it's going to push us a little bit lower now, which isn't a bad thing, because after making that video I thought, you know what, this is such a good buying opportunity. Like, the longer these stock prices stay at these sort of valuations, and as well if the businesses keep growing, this is a major opportunity. So if anything, I don't actually mind the share prices being down here for a longer period of time, because I get to accumulate great companies at great prices, which is always ideal. You know, if we had a stock market rally, what am I going to be doing? Well, I'm just going to be sat there building cash back up. So right now I get to keep, injecting that cash to buy shares in great companies at very good valuations. So yeah, but just to make it very clear for anyone that's new on this channel, as I feel like there's been a few new people that have come in the last kind of couple of weeks. Myself, I'm a long-term investor, so I invest for 2 to 5 years, and I'm not really bothered where stocks go in the short term. Even though I just said that right then, it's always good to keep up really where potentially you could go in the short term, but for me the thing that matters the most is the long term. I'm a long-term investor, and for me, I'm not really bothered where share prices might move in the first few months. If they move up 20%, if they move down 20%, anything can happen in the short term. My long-term game plan is identifying good companies in the next few years that are going to do very well, and try get share price appreciation of over 100%. So that would be on stocks like Greg's, stocks like Tesla, stocks like Square, like GWPH, all them sort of companies that we've done previously. That's mainly my aim to achieve while investing. So yeah, we'll go through these 4 stocks that I've been buying. I'll only spend a minute or two on them just to keep it brief, otherwise the video would be 1 hour, 2 hour long, and I don't think anybody would want that. Maybe you do, but I think a lot of people wouldn't want to spend an hour or two listening to me talk about these stocks. So we'll make it a quick fire one. But all these stocks, I will have a deep dive video on them on the channel somewhere. So yeah, and if you do want to know what I'm buying something in real time, the Patreon is the place to be. So join that with the link in the description. There's also 2 exclusive videos a week on there, and a Discord with 600 members on there as well. And that's probably why it's the highest Patreon to subscribe account on YouTube, which is obviously, I'm pretty proud of that. So yeah, thank you for you guys that are on there supporting the channel. So first up, you guys probably know this one was going to happen at some point. I've been talking about it a bit on the channel, so I'll keep this nice and brief. But Hollywood Bowl, so I bought this UK stock. I've been watching it for a while. I've always wanted to own more. I should have owned more, and I never have done. And they brought their earnings out, and I thought, you know what, I'm going to start buying some shares back in this one. And I am up over like 40%. Well, I was actually up 50%, and then I started averaging in a bit more. So that's obviously taken me down a little bit, but I'm fine with that, because in the long term, that like little 10% reduction on the average, I guess, I think will easily make a lot more in the longer term with how this company is producing, or how good its financials it is that it's actually bringing out at the moment. So yeah, I'm a big fan of Hollywood Bowl. It trades down to a P ratio at the moment of 9, which I think is incredibly cheap for this company. I pick up now a 1.3% dividend yield, which I think is also attractive. I think that's actually going to be a little bit higher in the next coming few months as it keeps on hiking up that dividend. So yeah, I think it's a good valuation. It's got a good dividend yield. The growth is very good when we look at it in a few minutes. The share price is nowhere near above pre-CV levels, even though the business is actually performing higher than the CV levels. And I think it's just a solid company that I'm going to pick up a good share price appreciation and dividend yield. I don't think this is going to be an absolute crazy one that's like a 3x, 4x, but I think it will double in the next 5 years, which is the key thing. And yeah, like I said, it's a good valuation. The dividend yield is very good. And when you look at the financials they've just put in recently, they put revenue growth of 36% in, group profit was up 52%, the dividend on, and this is on 2019 numbers, pre-CV situation, was actually up 32%, which is fantastic. And also in the recent trading update, they said that they're going to try and achieve more revenue growth and profit growth by opening up new centres in the UK, refurbishing old centres that might need a bit of an update. And when they've done this previously, it's actually increased the like sales quite a bit as well, which is good. And they've also bought a Canadian bowling company now. So yeah, it looks like it's actually going to go from being a UK company to a UK and a Canadian company as well. So kind of going a bit worldwide now. So that's going to be the growth drivers to watch in the next kind of coming up 24 months, the next 2 years really. So yeah, it's got a very good plan forward for the next part of its growth. And yeah, I think financially and valuation wise, it's very attractive at the moment. So like I said, it trades down at 9 times earnings, 2.4 times to sales. One thing that was quite impressive with Hold Bowl that I didn't actually realise is that it actually holds 85% gross margins, which is pretty impressive margins for something that's like a physical location. And if you do look at the past performance of the group, you can see here profit and revenue has been ramping up really well, and that's only continued after the CV situation. Now, I don't know why, but analysts are forecasting for revenue and profit to be a little bit flat going forward. Not 100% sure why that is. However, they are analysts, and the thing is if you continue to kind of increase your venues, obviously that's going to bring more and more revenue in, and obviously with acquisitions as well. I can understand the profit slightly being a bit in and out because of short-term logistic issues. However, yeah, I'm a bit confused really about why the analysts are forecasting this. I think it'll be a lot higher than this. Financial health wise is very good as well. They paid all the debt off on the balance sheet at the moment. They're holding 49 million in cash. That's obviously why they've gone back to a bit of a dividend at the moment. And you can see here, Simple Street actually have the dividend yield down as 2.6%. So I'm not sure if Google's is incorrect. And that's going to pump up to potentially a 3% dividend yield. So that's a pretty good dividend yield. And also you've got insiders buying as well, which is fantastic. So yeah, I think overall when you look at this, to be down at this sort of valuation with the growth that it's going to have, with the dividend yield that it has at the moment, I think it's a very good company. It's my third largest UK holding. I could easily make it my second. I could easily make it my first. My only little thing that I'm kind of careful of is just making sure I keep a good average on it really. So yeah, I'd buy some more Hollywood Bowl. And the second stock, which is a stock that a lot of you guys have been asking me about recently, saying what's my plans with this one, or am I doing anything in particular with this one, is Inmode. I did buy some Inmode, not last week, the week before. And with an Inmode compared to like a Hollywood Bowl, I would actually say that Inmode actually has more upside. I would say Inmode, it has a little bit more, I would say a little bit more of a higher risk to it. However, I think the upside on Inmode is probably more towards like at least a 3-4x. I think potentially depending on the long-term growth, because at the moment I've kind of got growth planned in for like high teen percentage going forward. If they actually beat that and actually end up growing like in the 20-30% rates, and obviously send that down to the bottom line on profit as well, this actually could come more higher returns than that. So it's a bit 50-50 on this one, because I don't exactly have a concrete on what their long-term growth and how that will translate to profit will be. But however, I still think worst case scenario, I'm still going to probably get 3-4x return on this one in the next 5 years, which is still pretty impressive. So yeah, it currently trades down at a 12 times earnings, which is incredibly cheap when you look at the numbers this company's putting in the next, what it has put in and will continue to put in, which is just insane. You shouldn't have a company like this at 12 times earnings. No idea why it is doing that, to be honest with you. I think this stock is majorly going under the radar. If you look here now, the 10th of June, it is the same share price as where it was around December 2020. When I show you the financials, you'll see the improvement in the financials of this company. In case you don't know, it's a bit of a picture to put on screen there. What they do is they do medical products, and these medical products are like surgical alternatives. So a lot of what you'd previously go for surgery for cosmetics and potentially to make yourself look better, which I think is going to be more and more of a growing industry. Rather than going under the knife, rather than going put to sleep, you can go for these treatments that Inmode produce, or these machines that they produce, and you can have these treatments done. You don't need to have any anesthetic put in you. You don't have to be put to sleep for them. You don't have to be in the surgery for a couple of days to recover afterwards. You basically can walk in, you have these treatments done, and then you can walk out straight away, and there's hardly any discomfort really. So I think this is a really good alternative, and you can see the results here as well. The results are great as well. So I think that will appeal to a lot of people, and also with the results being pretty good as well, I think they've got massive room to grow as they bring different models out for different procedures that they do currently offer. This was their recent earnings. The recent earnings were fantastic. The EPS was a beat. This was on preliminary earnings as well. So they brought the preliminary earnings out, which was a massive beat, and then they brought the normal earnings out, which once again was a decent beat. So the EPS was a beat here. The revenue was a beat here. You can see that they grew 31% year over year, which is really good. And it did actually give a outlook for the full year. Maybe the outlook was a little bit conservative. Maybe that's what the market didn't really like with it, I guess, really. But it was still pretty much in the ranges that were expected. And Inmode have a very big history of kind of sandbagging numbers and then beating that by a massive amount. If you've been following Inmode, you would have seen that previously. They have done that quite often. When we do look at Inmode and we look at the valuation side of it, like I said, it does trade down at 11 times earnings. It has gross margins of 84% and net profit margins of 44%. That is correct. 44% profit margins. That is insane amounts of money that go to the bottom line, which is fantastic. If you look at future growth, you can see analysts are projecting still very good future growth on this company. I would say that they look pretty much in line with what I'm kind of expecting, which if they do these numbers is phenomenal. The amount of profit that's there, revenue growth that's there is fantastic. If you look at the financial health, like we said earlier, the amount of profit that's going to that bottom line is insane. So obviously, as you would expect, there's no debt on the balance sheet. And they're currently sitting on 400 million in cash. So when you're a 2 billion company and you've got 400 million in cash, that's insane. So they've kind of started by doing a few share buybacks, which is positive. But with that money, they could go look for an acquisition, which they are potentially looking at. As well as that, if you're wanting to go to a bit of a dividend company, which isn't always my favourite thing to do, because with dividends, obviously you got to pay the dividend tax. So yeah, while there's still ways around avoiding that and doing that through more, what would benefit the shares, potential share buybacks or acquisitions, that would be more my way to go. But if they're wanting to do that, they've got the capital for it. And also, it is a founder-led company with the founders actually owning the majority of the largest shareholders inside the company as well. So overall, like I said, the profit might be a little bit flat this year because it's the first time they're having to start paying tax at the moment this year. So the profit might be a little bit of a flat one this year, but the revenue is still growing in a massive rate. And then when we kind of go onto the next year and we've kind of now priced in this kind of paying tax again, the revenue growth will still be very good. The profit will go back to growing, very good rates as well. So yeah, overall, I think that Inmode is fantastic. I think that the facts that we talk about in Inmode that's growing, 30+%, so good amounts of profit. We talk about 12 times earnings. Like, this is just, this is getting priced at a company that grows 2-3% revenue growth a year, and is not really a fantastic company. And you've got all this going for it. Like, it's just insane. Like, this company should be, without doubt, talking, 30-40 times earnings. Like, there should be a premium on this sort of company. And it's not even at the market average, which is just insane. So yeah, I'm a big fan of Inmode. I should really be buying more. I am still the funny thing is I'm actually still averaging up on Inmode. Crazy to think of that. Which I'm also being very careful of that. Same again, I don't ruin my average, but I think at $23 it's a bargain. So even if I had an average of $23, I'd still be very happy with that. So yeah, it's definitely one that I've got to prioritise. And the third stock, you probably would know this would pop up at some point. It's the king, it's DraftKings. Obviously, you guys that watch the channel on a regular basis know that I am an ultra bull on DraftKings. It's a stock that I'm going to hold for at least 5 years. I think even it could potentially be longer than that. And in my opinion, this is the most exciting stock that I've seen since I invested in the likes of Square, Tesla, the likes of Shopify. I think this is the best company that I've seen for many years come onto the stock market and at a very attractive valuation. I think when you look at the TAM potential in the next few years, what DraftKings has is just exciting, and it's why it's my biggest position. I'm going to back the stock that excites me the most, the one that I think in the next 10 years I just can't wait for the upside. And I think when you look at the risk side of it, sure, it's a little bit risky because they are losing money, but I think that it's because it's in an industry that's been proven, like this industry that DraftKings is in has been proven to be successful in the UK. And if anything, the US market and TAM has more potential than the UK TAM. So if it's a business that has a business model that has been proven to be successful in every other country in the world, and now we're in the US. Why is it not going to be a successful industry in the US? It's as simple as that. And if anything, I think the TAM's only going to be bigger in the US, which is so a massive opportunity here. So I am trying to buy as many shares as I can in DraftKings at the moment. It's currently sitting down at $13. I don't think it'll be down here forever, so I'm going to take this opportunity to pick it up around about a 6 billion market cap. You know, the same sort of prices it was at when it came on through a SPAC, obviously not counting for any shares that was then obviously put onto the market, but a 6 billion market cap at the moment, which I think is a very good valuation for this company right now. And we come off an earnings report a few months ago, which was absolutely fantastic. It had a good pop after its earnings report, even though it gave it back as the day went on. And in fact, the last kind of 5 earnings reports from DraftKings have been like 10 out of 10 earnings reports, which is great. The company is on absolute fire, and the Investor Day as well is an event that I always go back to listen to. I thought it was a very good Investor Day. It basically ticked out all the boxes that you wanted to hear as a long-term investor. Basically saying that the TAM is bigger than what was expected, which we hear basically every year, that the TAM is growing faster and faster. So yeah, that's obviously great. It's taking market share wherever it goes. You know, it is one of the top 3 operators in the US, and as long as it kind of holds a 20% share of this market, it's going to do very well, and that's what it's doing. It is also now moving towards profitability. So it has 5 states now that are contributing profit, and by the end of this year, it's expected that there's going to be 10 states now producing or contribution profit, which is insane to hear. So yeah, the path to profitability is very much on at the moment, which is exciting. And if anything, when they've looked at the states that are the more mature states are now they've increased the long-term adjusted EBITDA outlook, because what they're realizing now is actually the profitability we can get from these states in the longer term is going to be even better than what we expected, which once again, that's what you want to hear. You want to hear that there's going to be the potential revenue you're going to make is even more in the future than what's expected. The profit's going to be even more than what's expected, and the path of profitability is moving faster than what you were expecting. So yeah, it's fantastic. I'm so excited for this company. So I won't spend any more longer on DraftKings, because I've talked about it so much more on the channel, but just a bit of a recap there for that one. And that leads me on to the last stock, which is Shopify. So I have been trying to buy a few more shares in Shopify when I can. I think obviously e-commerce is having a bit of a tough time at the moment. However, Shopify is here to stay for the long term, and it is the go-to platform for small sellers, large sellers. It has so many features in it that it just sucks you in as a seller, and it's very hard to move away from that platform, because Shopify offers so much to the seller, and it's just going to bring in more and more sellers. You know, if you're ever going to start an e-commerce business, you're going to go to Shopify for it. And yeah, I think the moat on it is massive, and I think the product and the service is fantastic as well. So this company's now dropped down to a $340 stock, meaning that actually it is the same price as it was. Well, in fact, it's actually lower than where it went in to the CV situation. So, you know, we've basically wiped off 3 years of share price gain off Shopify at the moment. And even in this kind of tough period of time, Shopify actually put in a pretty decent earnings report. There is a revenue growth still growing pretty strong. However, profit is a little bit moving in and out at the moment as it reinvests into the company through acquisitions, changing its business model. However, the long-term business model is very much intact with Shopify. And when you look at the growth side of it, like I said previously, if we just go on, let's go on here, this past growth. You see, you went into the CV situation losing money, and you're doing 1.7 billion. We're now at a point where we do make profit, and it's 4.8 billion, and like I said, it's valued at nearly the same. At the moment, is expected to lose a bit of money this year. The reason why is because it's same when it shot up a little bit in profit. It's to do with a firm and its stake that it has in firm, and also acquisitions. So this is going to just be a one-time off loss. So you'll see here that it will actually then rebound as these investments kind of start balancing out a little bit, and it also reinvests quite heavily into the business as well. But revenue is still going to go massively in the right way, and financial health wise, it's still pretty strong as well. It's got a pretty strong balance because it historically doesn't lose too much money. it kind of keeps a thin line where it can still reinvest into the company a fair amount. And that's quite evident when you look at the financials. Like, the revenue is still very strong, and you look at the gross profit, they have, like, you know, very good gross profit, but they just reinvest so heavily into the company. You know, 300,000 in sales and marketing, 300 in research and development as it expands more of its kind of logistic part of the business, and also 100,000 into general G&A. So yeah, I mean, if you want to be a profitable company, it could be, but it just reinvests more and more into the company to, you know, keep up its market share, and that keep up the moat and keep sellers, you know, sucked into the business. So yeah, I think it's fantastic. I think, you know, this is a sort of company that it could easily be doing, you know, 1 billion in profit in the future. And when you start thinking about, it potentially could even do 1 billion profit right now if it really wanted to. But it keeps reinvesting. I think in the future, you know, you're going to be talking about a company that does generate 1, 2, 3, 4 billion in profit. And then when you start working that out, I think the valuation is very attractive for this one. So yeah, I've been trying to buy a bit more Shopify when I can, because I can't believe that we are at below CV prices for this one. So those are the 4 stocks I bought anyway, guys. I tried to keep it brief, but I still went over a fair bit. So well done to you guys that stuck all the way to the end of the video. If you could, hit the like button if you're new, subscribe, and I will see you on Monday for the new video.